Hello, I'm Kori Smith. Welcome to Concierge Real Estate's Home Series Workshop. This episode is brought to you today by eCapital Mortgage. They offer customizable loan options with very attractive payment terms. With me today is Jeff Bubenchik.
Hello.
Hi, Jeff.
Good to see you.
You too.
Thanks for having me.
You bet. Thank you for being here.
Anytime.
Yeah. So we've been joking a little bit about the crazy high interest rates that we've been hearing about, but it's really no laughing matter.
Not a joke, is it? Yeah.
Yeah. So can you tell us a little bit about yourself and then we'll kind of get into
Sure. So I'm Jeff Bubenchik with eCapital Mortgage, the branch manager there. And I've been in the industry since 2004, so almost 20 years now. That's not aging me by any means. I started when I was 10. I've been in the industry a long time. We just moved to eCapital Mortgage. It's been a great switch for us, for our clients mainly, and for your clients, because they offer a huge variety of banks that we can go to for different products and stuff like that, rather than being locked into just one bank.
Okay, awesome. All right, well, interest rates today, we've heard they've all gone up. How bad is it?
Historically, it's not that bad.
Okay,
that's the good news, right? We still see some high fives, mid to low sixes. Historically, that's not bad. Let's just take it back to 2007. 2007, we were doing purchase rates at 7.25% and 7.5%. So that's really not that long ago.
True.
And they came back down after that. Typically, when we see a recession, I hate to say the word, but rates tend to come back a little bit. So that's a good thing. Hopefully, we're headed in the right direction.
Okay.
But we haven't seen a huge spike upwards like we did a couple months ago. So that's good, right?
Hopefully it's leveling off.
Just plateau a little bit. Yeah.
That would be nice.
Exactly.
Yeah. Excellent. All right. If I was a buyer today and I wanted to come to you for a loan, what's the first thing that they would be wondering for a loan?
Well, the first thing people always ask, what's my payment? Right? Well, what's my rate? What people don't understand is there's a lot goes into it. You're looking at your debt to income ratio, your credit score, how much money you're putting down, things like that determine where you're going to be rate-wise. So that's all a factor. So you might have a different rate than me, than Joe Blow or anybody else, because of you're not putting down as much money, or I have a lower FICO score, or whatever it may be. So it's an individually tailored
Gotcha.
type of thing.
Right. So if I hear on the news that, hey, rates today are at this rate,
Right.
that might not be necessarily true for just me.
Right. And what the news is reporting on is the base rate, whatever the mortgage companies are saying the base rate is for that day. But that might not be necessarily true. I mean, you can go online and get a wide variety of rates. And unfortunately, some people have been taking advantage of that by broadcasting low interest rates right now, getting you come in, and then it flips the switch, right? And something came up and now you're higher.
Gotcha.
So,
so beware of that.
Yeah, beware of that, and try and go with somebody you trust or your real estate agent has worked with in the past and trusts.
Right.
That's a big thing, because you as an agent, a broker especially, working with all the agents that you employ, I mean, you see a wide variety of things coming through. Yeah. And in different communities, it's different as well, too. I mean, lending up here in Mariposa is a little different than lending down in the valley. We have all kinds of weird scenarios sometimes that come up here.
Good point, right?
Yeah.
Our houses have more things going on. Wells and septics.
And road maintenance agreements and,
right.
non-county maintained roads.
So it helps to have a specialist that knows the area.
Right. Yeah. Knowing the area is important.
Yeah.
So
excellent.
I mean, I've done loans in Texas and Nevada and everywhere else too, but being from here, I think that kind of helps.
Sure. Yeah. Excellent.
So,
well, that's wonderful. And then with today's rates, it still seems advisable to get in and buy the house, right? Prices have come down a little bit, and
prices have come down, as you've seen, a little bit. I mean, not like a crash of 2008, as we were talking about earlier before we came on. I had people back when rates were low saying, well, I'm going to wait for the market to crash and then I'll get in because prices will come down. Well, that's not what we saw. We saw rates go up and prices stay fairly where they were. To come down a little bit. If you were qualified at 3% for a $400,000 house, now at 6%, you're qualified for a $350,000 house. But there are some things that we can do that help them with their rate payment. There's different programs available. We have the 2-to-1 buy down that's come back.
What is a 2-1 buy down?
Well, let's say today's rate is 6%. Okay. And that's where you qualify. If you do a 2-1 buy down, what it does is the seller has to pay for this. The agent would negotiate with the seller.
Okay.
The seller pays for basically your interest rate to be 4% the first year you're in the mortgage. And then after the first year, it goes to 5%. And then after the second year, it goes to whatever the rate was you locked in at.
So for 2 years, it starts out lower and goes up until it gets to the full rate.
Right. For example, just say you had a $300,000 loan mortgage. And from going from that 6 to 4%, it might save you $450 a month for the first year. A lot of people like that option because they're kind of gambling on the market, so to speak. Mm-hmm. We get into a 2-to-1 buy down if within the first year, say rates drop to 4%, you can refinance. Mm-hmm. And you refinance and you lock in at whatever rate you can get then. And that money that the seller credited you to go into your 2-to-1 buy down, that money actually goes into a trust. Okay. So whatever money is in there and you refinance, that's your money to use towards your closing costs on your next loan. Okay. Oh. So you get that money back. It's still yours. Okay. So it's not a bad option. Right. And it's a short-term remedy to long-term rates, right?
Sure.
So there's other options that people are doing because sellers have been a little bit more negotiable right now because of the market. We're seeing a lot more seller credits to help credit towards closing costs. And a lot of times you can do a long-term buy down there, which is basically buying your rate down. You can ask the seller to give you, say, a 3% credit or something and use that 3% to buy your rate down.
Oh, okay.
Yeah. But
so if you buy the rate down, then the interest rate's lower because they've paid for that privilege?
They're paying to buy your rate down. Yeah.
Okay.
They're paying points, right? Okay. People always ask, what are points? They're called discount points or whatever. Yeah. So 1 point is 1% of the loan amount. So $300,000, that's $3,000 is what a point costs.
Okay.
So say you spend that $3,000 to buy a point, it's not going to take your interest rate down 1 point, though.
Oh, it's not? Okay.
No, this is the thing. And this is why you have to look at each individual and see where they're at. But you might pay 1 point to get your interest rate to go down by 1/8 to 1/4%. If it's only 1/8, that means it's going to take you almost 8 years to get your $3,000 back off of what you save on your payment. Oh. If it goes down 1/4, now it's going to be 5 years, 4 years.
So you have to think about it as a long-term return, but maybe it's not really worth.
Yeah. So if it saves you $25 a month on your payment and it's going to take you 4 years to get that back or 5 years to get that back. And it's hard for people a lot of times, especially first-time home buyers and stuff, to say, look into the future, right? But the average term that people stay in a mortgage is 4 to 5 years.
Oh, okay.
Before they refinance, they move up into a bigger house or they downsize or one way or another, or they need to take cash out to put their kids into college or whatever it may be.
So do you think it's good to go into it with like a 5-year plan? Like, is that what you kind of coach?
I usually sit down and I ask my clients, what's your plan? Like long term, where do you see yourself in 4 to 5 years? What are you going to do? Mm-hmm. I listened to Dave Ramsey the other day and he said, that average term on a home that people stay in a home before they sell it again in the United States is just over 7 years.
Okay.
Yeah.
Right. So it makes sense then to have a plan like that. And I could see why it's really useful to have an expert like you to help guide them through that.
Right.
Those are things that, might not have thought of had you not, because you're in the business, to watch out for them and say, look, let's think about this and examine the options, right?
Right. Yeah. So there's a lot of things we can do. And like I said, that's why we like to individualize and tailor the loan. The biggest purchase in your life is usually your home. So you need to get with somebody who's not going to just run you through the mill and get you into something that you probably didn't need to do or spend money you didn't need to spend, especially in these times when everything's so expensive, every penny counts.
Right. Yeah, definitely. Well, those sound like excellent strategies. Those are really helpful. Yeah. And then for a seller, what's something that since it's a bit competitive, right? Right now, because there's less buyers because the interest rates are a little bit higher.
Right.
What can a seller do to work with buyers?
Some of the things I touched on, like what we're seeing now, some of those seller concessions, maybe you have your home listed for $400,000 and the neighbor just sold theirs for $380,000 that's comparable and you're like, ugh, or whatever, or you're getting offers at 380, 385. Well, split the difference. If you're happy with 395, maybe say, I'll give a seller concession of $5,000, or go to 405 and say, I'll give you a seller concession of $10,000 and cover your 2-to-1 buy down so you have a lower rate on this house rather than going into the one next door that's not as nice. Biggest thing I can tell sellers is to work with the agent and the lender and see what their options are when it comes to that thing, because there's all kinds of things you can do creatively that kind of help out.
Yeah, that's excellent.
Yeah.
I think that's good advice for sellers to have in mind to make their home more attractive, and,
Right.
and then rely on your agent to help negotiate that for you.
Yeah, and especially in the market today where, just 6 months ago, sellers were coming in and buyers were offering more than asking price, right?
That wasn't that long ago.
That's gone now. So
Right.
yeah, now you got to think about what you're doing and what you really want to get out of that house.
Sure. Yeah. But it's still a good time to sell. And
It is. Prices are still high.
yeah. So it's a good time. It seems to be good for everyone. You just have to kind of massage it a little bit, right?
Right.
Know where you're at and have experts to help guide you during this time.
Exactly.
Yeah.
Exactly.
Excellent. Wonderful.
Yeah.
Yeah. Well, thank you so much.
You're welcome. Thank you for having me.
Yeah.
We're going to go with questions.
Yes. So
With our
from the audience, I'd like to open it up for questions. If anyone has any questions for Jeff or I.
I covered it all. Awesome. I'm so good.
Hi, Jeff. Hi, Kori. How are
Hi.
you?
Good.
If I wanted to buy a house today, kind of give me an idea. How much money would I need to put down on a house?
Well, that depends because there's different programs out there. You could put down 20%, which is the typical conventional type loan. We also do conventional loans with just 3% down. There's FHA loans that require 3.5% down. The USDA loans require 0. So do VA loans require 0. So it could be 0. It could be as much as you want to. A lot of people like to put 20% or more down because they don't like paying what's called mortgage insurance. And mortgage insurance is basically just an insurance policy for the bank that if you get foreclosed on and there's not enough equity for them to sell the house, they're safe.
All right, thanks. If I wanted to come and talk to you just to find out, just to see where I stood, am I committed in any way, or can I just come and have you answer questions for me?
You can come and answer. I'll answer any questions. We work on commission, so we don't get paid until the loan's over. But I've worked with clients for a year or two before we've actually got them into a loan. The best thing to do is to get an application in, see where you stand credit-wise and all of that, because if there are any credit issues, we help our clients for free resolve those issues as much as we can. And if it's something that's very serious, we have people that we work with that can help resolve those issues too for the client. So like I said, I've had clients that come in, they apply, they're not qualified. We work with them, say over the course of 6 months to a year even, and get them in a position now to where they're going to be qualified for a home loan and they can buy.
Hi, Jeff.
Hi.
I've been working with a client who's repairing their credit.
Mm-hmm.
It's a couple who's been in some trouble over the last 4 or 5 years, and they're in the process of repairing that.
Perfect.
I mentioned to him that he might want to get some advice and talk to a lender to see if they qualify. And he says, I don't want to do that because that's just going to be another hit on my credit score. So it's kind of a fundamental question. Is that still taking place where if I apply for a home loan, that's a ding on my credit?
No, unless I pull your credit. And if I pull your credit, that's called an inquiry. It may or may not affect your credit, but inquiries really affect your credit very minimal compared to maxing out credit cards or compared to your history and stuff like that. For example, say your credit history, that's like 30% of your score, okay? Your credit limits, okay? That's probably another 30 to 40% of your score, somewhere in there. So what I've seen people do to get themselves in trouble is they get an offer on a credit card, right, for $5,000 and 0% interest for whatever. They have 5 credit cards that are maxed out at $1,000, or not even maxed out, but have 1,000 on them. They say, I'm going to put all these onto this one. It's 0%. That makes sense, right? Well, what they've just done, and then they close all these accounts. So they just erased all their credit history because once you close the account, you don't get any credit for that. And they just have a brand new card that they maxed out. So they go from a 700 FICO to a 600 FICO, just like that. If you have a client that's working with a credit repair company already, I can contact them and they'll let me know where they stand if it's okay with the client. Okay. I don't have to pull their credit right then. I shouldn't pull their credit right then. But inquiries, people always say, well, I'm going to go to this mortgage guy and this mortgage guy and this mortgage guy, and it's going to ding my credit. That's not true. You have a 30-day window to shop for your home loan. So you can go to 3 different mortgage guys and we all pull your credit. It's not going to lower your credit score. If you go to the mortgage guy and then you go to the auto dealer and then you go to the jewelry store and they run your credit, that's when the inquiries get you, because it looks like you're spreading yourself out. That answer your question?
Yeah, sure does.
Perfect. Have your client call me. I'll help him out.
Hi, Jeff. I was wondering in regards to your debt to income ratio, is there a difference in loans that will actually you can apply for and then get through?
Absolutely. So debt to income ratio is how much money do you make and how much do you have out there, right? And and once we add that home loan onto it, what percentage of that's going to take up your income? Different loan types have different variations or different rate debt to income ratio guidelines that we have to follow. Conventional loans are a little bit stricter than VA and FHA loans. USDA loans, which is the zero down program up here in Mariposa, they have very, very strict debt to income ratios that are actually lower than conventional loans. But it's a zero down program, so they want to make sure you qualify correct. That's one thing that your loan officer should be going over, is your debt to income ratio and what program fits your needs at that time.
Thank you.
You bet. Hi.
What kind of options are available for people who want to buy land and build?
There are construction to permanent loans that allow you to purchase the land, build the home, and then it rolls into a regular 30-year fixed after that point. They're very tricky, so you want to make sure you get with somebody that's done them before. You need to have in a reasonable amount of time, because you only have so much time on a construction to permanent loan to complete the project. And then there's penalties involved after that, and we don't want penalties. So you really got to have all your ducks in a row, have your contractor, your plans, all that stuff ready to roll, and then get going on that. But you can also do conventional loans, and there's FHA loans and stuff like that are construction to permanent.
Thank you.
You bet.
Can you finance manufactured homes?
Yes, we can finance manufactured homes. They have to be built after I think it's 76.
Yes, it is.
Yeah, 76. Yeah. Actually, it's June of 76. Can't be before that. They have to have the HUD placard on them still. They have to be on a permanent foundation, and that doesn't mean a concrete slab. That means just anchored appropriately for the state of California. And they would have something called a 433A recorded with the county, stating that it's on a permanent foundation. But yes, to answer your question, we can do manufactured homes.
And that's something the agents can help find out for the lender.
Right.
Figure out if it's on a permanent foundation. And,
yeah.
Yeah.
And if you have a client that does have a manufactured home on a permanent foundation, make sure they keep their engineering certificate. Because when they go to sell, that's something they can say, hey, look, I have the engineering certificates because I just saved you $600.
Excellent.
To the buyer.
Okay. Otherwise, you have to
order another one, and it costs $600 or so. Yeah.
Had to do that.
And it takes time.
And it takes time.
Yeah.
Hey, Jeff, just curious. I think probably a lot of buyers would be very interested in the FHA loans, first-time home buyers. And I know you mentioned there's a 0% down with FHA.
There is a bank that we have that would offer, that would do 0%. It would cover the 3.5% down payment. So there is that, a little bit tougher to qualify for, but there is options. There are down payment assistance programs too, that there are options for. They all have different terms to them. When you have clients, I'd be happy to go over those with them because they're all specific.
So the 0% down would be more than likely a higher interest rate? Is that correct?
Yeah. The less money you put down, the higher your interest rate goes. It's just one of the, it's a risk factor.
Right. But it's a nice vehicle sometimes to get in if you don't have any.
Right. I mean, if you have no other options to get in the home and get you in the market, I mean, we've seen home appreciation. It's still there.
Yeah.
Right.
It's still good to get the home, and then you can be making payments towards it and get your payment down, right?
Absolutely. And then when rates do come down, refinance and get out of that.
If you have a property that has a stick-built home that's pre-existing, but that has a secondary home of a manufactured or mobile, how would the financing go on that?
That can get tricky.
Okay.
It would depend. Does it qualify on a permanent foundation and all of those guidelines, right? If it does that, it would be a second unit, and that's okay.
So if it didn't, then
If
they
it-
could take it off the property and then finance that.
You can take it off the property and finance that. I have other ways that we can get around those things, but yes, to answer your question,
Yes.
maybe.
Okay.
Maybe.
Maybe it's perfect.
Yeah, I'll give you the law school answer. It depends. Yeah. Well, thank you guys all for coming, and Kori, thank you for having me. It was really
my
a pleasure.
Thank you,
Yeah.
Jeff. It's been wonderful having you.
All right. Thanks, you guys.
You've given us a lot of information. Thank you.
You're welcome.
And hopefully everyone watching got some good information from this. If you have more questions, you can reach out to Jeff. Our service is also for buying the home. Any other questions, we're happy to help. No obligation. Thank you all for coming. Thank you for watching. I hope you've enjoyed this.
Yeah.
And we'll see you next time on our home series workshop. Thanks for watching.
Thanks, guys.